Greetings, everyone. It's Angelo Robles, and welcome to my Family Office TV, where I have an opportunity, sometimes multiple times per week, sometimes just once or twice a month, to interview amazing people. Today, I have an interview. This will be my back to back on my platforms with an Italian in Italy. Forget about North America. I'm going back to my heritage, my roots. This is so exciting. So today it's European macro strategist on making money in chaos. And trust me, we are in chaos. Our special guest today is Alfonso Peccatiello. He's the founder and CEO of the Macro Compass, a disruptive investment strategy firm focused on financial education and unique macroeconomic insights and actionable investment strategy. He will also be the chief investment officer of his own macro hedge fund, and he has a lot of experience managing significant amounts of money. Before that, Alfonso was the head of investments for a $20 billion portfolio, a little company you might have heard of called ING. Alfonso, welcome to the show.
Angelo, such a pleasure. And I have to say, your pronunciation of my Italian surname was perfect. It really speaks to your Italian heritage here.
When you got a first name like Angelo, you can't be messing up Italian names. It'll be embarrassing. Nonetheless, let's get right to it. I'm going to start with a comment that's going to weave into a question. Inflation, we're always told, is caused by one thing and one thing only, a more rapid increase in the money supply than the output of goods and services. I mean, maybe, but does that really only apply to assets? And is it rising wages that causes inflation? Because often the minimum wage workers don't save as much as they should. They spend that extra money in the economy, and that causes more day-to-day inflation. You could very well disagree with me because what I said in both part one and part two is probably a little off the wall and controversial. What would be your take on inflation?
I would say that an economist a bit smarter than me, Angelo, once said that inflation is always and everywhere a monetary phenomenon. And I would say that I agree with him as long as you can measure money correctly. And if you look at the inflationary bout that we have had over the last 2 to 3 years, basically from 2021 onwards until today, and we're still living in, you can look at the money creation that has happened into this period and understand the close relationship between the two. And who has printed money, a lot of money over the last 2 to 3 years, is not the Federal Reserve. Yes, the Federal Reserve, the European Central Bank, the Bank of Japan, they have printed a form of money that is called bank reserves via quantitative easing, and they have done so to oil the financial machine. They print a form of money that remains in the interbank system. It makes financial markets more liquid. But we have seen that, Angelo, for the last 20 to 30 years in Japan. And US has done QE, and Europe had done QE before that. So why is that this time money printing got inflation? Because there was another big money printer which was inactive for many decades. And these are governments through gigantic fiscal deficits. And that is the form of money that ends up being thrown to the real economy, ends up in the pockets of people to spend, as you were saying before. Even people that are on the low wage side got checks sent at home in the mailbox by the US government through fiscal deficits. And as if it was not enough, in 2023, with a very hot economy, Biden has gone through it again and has unleashed another wave of fiscal stimulus on top of an already hot economy. And so this is causing the sticky inflation that we're watching, because inflation is always and everywhere a monetary phenomenon, especially if real economy money, the money that can be spent by people, by households, is getting printed. And that is the result of fiscal deficits. And we have seen that in big size being used as a political weapon nowadays. Once upon a time, Angelo, I remember when politicians were using fiscal stimulus as a way to backstop economic weakness. So you had unemployment rate goes up, and then you had politicians come in with fiscal deficits. They were trying to support a weakening economy. But today, instead, fiscal deficits are used as a political weapon. And when you do that, you sometimes can overheat an already hot economy, and inflation comes up as a result.
Would you agree that inflation could be relatively individualized, meaning that it's different things to different people? We can't always believe what we hear from the government, what a shock. But even if we were to believe their inflation numbers here in the US or anywhere around the world, I could live a totally different lifestyle than someone else who's eating filet mignon and buying art and buying stocks going up and buying things that are increasing in value as an asset inflation greater than what they're claiming to be the 3 to 4% inflation. I've kind of always said for the super rich that are active in their lifestyle, I'm not so sure that their true inflation, maintaining their purchasing power, is really not 10 or 15% a year.
Yeah. And so we need to clarify a bit, what do we mean by inflation, Angelo? Your question is very smart, because when we look at financial markets and analysis, you will always refer to inflation as CPI. Okay. And CPI is basically a basket of items that the government deems to be the most representative for the median household. Okay. It's a basket of goods and services, and we will track the prices of this basket, right? But the reality is something else. First of all, the median household does not represent the whole distribution of households. And if you're on the right side of this distribution, or you're particularly rich, for you, the situation is a bit different. What you really care about, and for you, what inflation means, is being able to preserve the purchasing power of your capital over time. That's what it means, okay? And so your basket of goods, your baskets of services can be completely different. And inflation for you can mean a totally different thing that CPI means. Your main objective is to make sure that the real purchasing power of your capital is preserved over time. And then from that perspective, what you care about is, yes, the inflation that is generated by real economy money printing, but you also care about the inflation of assets, because your portfolio will indeed be built through nominal assets. Most of these assets are nominal in nature, which means they go up as the inflation rate goes up. They are inflated basically in the process. And you want to create a portfolio that somehow makes you able to benefit from this trend. For you, it's important as well to look at the inflation of financial assets, not only of the economics and standard inflation basket people are looking at.
And this is way too simplistic and probably a little bit of a hot take. Could I make the argument related to what I said in your commentary on that, that if I look at the S&P 500 and it goes up, I'll make my math easy, 10% a year. Could I make the argument that that really is arguably an inflationary number that I want to benchmark to, and that I want to have the assets or my income growth as an entrepreneur or as an employee match that or exceed that? Otherwise, I'm slowly trending down on my purchasing power.
So, Angelo, I would say there is a thing that I call the neighbor tracking error. So this is a concept I need to introduce for a second. What's the neighbor tracking error is basically you becoming less wealthy than your neighbor over time, okay? And your neighbor, in an environment where we have built this passive investing industry that invests in indices and ETFs and so on and so forth, your neighbor wealth is most likely invested in the S&P 500 for a large share of it, okay? So from this perspective, I think you're totally right, because your neighbor will have the S&P 500, which is a market capitalization weighted index, which means your neighbor will also own NVIDIA, for example, okay? It's part of a market cap weighted index. As NVIDIA becomes more and more bigger and bigger from a market cap perspective, your neighbors holding on NVIDIA also go up over time. And if NVIDIA is performing particularly well and you don't own it, then you will be tracking behind your neighbor. Okay, you will have a neighbor tracking error. So does that mean you should just stick to the S&P 500 as an investment philosophy to try and track basically the wealth generation coming from your neighbor, okay, for simplicity reasons? I don't think so. I think what you should benchmark as a wealthy individual, your performance and your objective towards, is you should change your denominator from dollars, euros, pounds, yen to gold. Now, what happens if you change your denominator to gold, Angelo?
Hmm.
What you are doing is you are saying, as a wealthy individual, I don't want the denominator of my assets to water down my purchasing power. I don't want the dollar, the euros to be slowly depreciating over time. So basically bringing back my purchasing power and cutting it over time. Instead, I want to try and generate enough returns so that I can at least match the returns of gold. So basically, I'm changing the denominator of my assets. If you do that, you will see, for example, and I posted recently something about this, that with 10 bars of 10 kilos of gold in 1929, 100 years ago, Angelo, with 10 kilos of gold, you could buy the median house in the United States. Today, 100 years later, with 10 kilos of gold, you can buy still the median house in the United States. What does this tell you? It tells you that if you had invested in real estate, you were able to preserve your real purchasing power over 100 years. So you have achieved your objective. Your benchmark, which is gold, remember, you have changed the denominator of your assets into gold. By changing this, it means you have preserved your purchasing power with the same amount of 10 kilos of gold. You were able to buy a house 100 years ago. You're still able to buy a house today. So if you change the perspective and you have bought real estate with your assets, for example, you were able to preserve the purchasing power of your assets. If you had bought stocks, you were more than able to do so, and so on and so forth. By using gold as your benchmark, you are sure that your returns are not measured against dollar or euros or other fiat currencies that can get devalued over time, but your returns are measured in a currency, in a competing form of money, which is gold, that cannot be depreciated and printed, whose supply is limited by nature.
Excellent. That actually segues pretty well, which you partially answered to my next question. And we'll come back to gold as well a little bit later. And that is, what is an inflation hedge? I could look back to any specific year, whatever, 1974, gold, other times, dividend stock, common stock, real estate, arguably, although it's been incredibly volatile, Bitcoin.
Yeah.
In other words, I think what I'm getting to is I'm not really sure if any one thing. I mean, lately, cocoa's been that's been the best performing sector within commodities. Incredible the last year. Therefore, I'm of the perspective, which may be contrarian, that there is no one such thing that is a true inflation hedge. You made a good point and argument for gold, but in relatively small blocks of time, 1 year, 5 years, 10 years, I think it varies. I don't know if there's any one thing that is an incredible hedge against inflation. Some would argue at right times the US dollar. What do you think?
I think you're completely right, Angelo. And of course, I took a very long time horizon of 100 years, which is not even applicable in, many time horizons for investing. So if you lower your time horizon to a behaviorally relevant time horizon, 5 years, 10 years, something where if you haven't hedged against inflation, it might bring you to do suboptimal decisions, right? If you look at these time horizons in history, there have been different assets that have hedged against inflation in different periods. And why? And why? Because the structure of the economy changes over time. The structure of our monetary system changes over time. So in the 70s, for example, during the inflationary bout, what performed really well and protected against inflation was commodities. Okay, so you were living in an economy which was highly, highly industrialized, high labor intensive type of economy. So when you add inflationary booms, what happened is that there was a big scarcity of resources. The demographics were very young. The economy was labor intensive, resource intensive. It was a very different economy than today in the 70s. And so commodities were your inflation hedge. They were the scarce resource you were looking for when nominal growth was picking up and the world was going strong and resources were scarce. Commodities did very well. But then instead, if you look, for example, at 2022, right, we had another big inflationary bout in 2022. Did commodities protect you from inflation? Not really. They didn't do particularly well. Gold actually was down in 2022. So what did instead? Well, the dollar did pretty well. And
Yes.
why? And why? So I have the long dollar, for example, as a factor in my asset allocation model, because in some cases the dollar can, weirdly enough, protect you from inflation. Why? Well, there is a big difference between the 70s and today. The entire world outside the United States has accumulated $12 trillion worth of debt, which is denominated in dollars, but wait a second, not issued in the United States. So this is issued by Brazil, China, Russia, any other company that has basically levered up their balance sheet in dollars because they want to participate in global trades. 70% of services, goods, and commodities that are traded worldwide are denominated in dollars, Angelo. And so other countries understood that they wanted to get more access to these dollars to boost their business models. So they did what? They borrowed in dollars. So what happens when there is high inflation? Well, the Federal Reserve will have to come in and raise interest rates, right? Now, what happens? By raising interest rates, they will make the cost of servicing this foreign denominated dollar debt by Turkey, by Brazil, by China. They will have a harder and harder time because they need to service this dollar at higher and higher interest rates. And so what happens at that point? Well, it's a rush to try and get your hands on as many dollars as you can to pay back your debt because they're becoming too expensive. And so guess what? Inflation goes up, and it's like a rush towards the dollar to try and get your hands on cash dollar to pay back your debt. That's why the dollar can actually serve as a hedge for inflation in certain periods today, while in the 70s, that wasn't the case at all. So you're completely right. Inflation can take many forms. It can be financial. It can be driven by bottlenecks in the real economy. It can take different forms. That's why diversification is really key for a family office or for a long-term investor, because there can be different asset classes in your portfolio doing different things to protect your wealth over the long run.
And it really segues into my next comment and then question, which most people would disagree with me, and it's okay. My hot take, sometimes again, I like to be contrarian. If you can borrow in your own currency, one more time, if you can borrow in your own currency, is debt really like our central bank printing here in the US, the dollar, ever a problem? A little more context. An individual or private business, too much debt, that's a big problem. Government, it's not a problem if you're borrowing per se, as long as you're the reserve currency. So I can make the argument, does our deficit of 34 trillion scare me? It does, and we'll get a little bit into GDP, the impact of AI. But as long as the US, and they'll militarily protect it, as long as the US is a reserve currency, do we tend to overblow our deficit in the US a little bit?
Yes, we do. And I'm very glad that you put it in this perspective. I have never heard so far a financial commentator coming with this take, because it's much more glamorous to say that the US will fall under the big weight of their debt. Well, let's think together for a second. If you are an individual or a corporate, okay, and you're levering up and you're levering up and you're issuing more debt and you're taking on larger and larger mortgages and corporate loans and everything, there will be a point at which this becomes unsustainable, because you need to repay and service this debt and these mortgages through income, through earnings, through your salary, okay? So unless you're able to grow your income and your salaries ever and ever and ever, you won't be able to sustain a larger and larger and larger amount of leverage. Basically, Angelo, I cannot print money to pay back my mortgage. If I want to pay back my mortgage, I need to do something. I need to earn money. I need to make money, okay? So there is this obvious limitation. And now people tend to say the same about the United States government. They look at the United States balance sheet as if they're looking at your balance sheet or my balance sheet. But it's not the same, because the United States government issues the very dollars that the US people use. The US government is the issuer of the currency. So the deficit itself, what does that mean? What is a deficit? A deficit is the government deciding they want to blow a hole in their balance sheet. They want to lower their equity position into more negative level because they can, because they are the issuer of the currency, and they do that, and they throw resources at the economy, and they say, I'm going to cut taxes for Angelo. That's why the deficit goes up, right? Because at the end of the day, I'm getting less taxes in, and I'm giving more resources to Angelo. I want to cut corporate tax. I want to send checks at home at people. Now, is there a limitation to that? Yes, there are two. The first is if you borrow or if you do this exercise not in your currency. If you do this exercise in a foreign currency, as we were saying before, Brazil issues dollar debt, then I'm sorry, but Brazil cannot print dollars to cover this hole ad infinitum. They don't have access to dollars directly. But the US is issuing debt in dollars. And actually, other countries are willing to buy US debt because of the system we have built. The system we have built in a system in which Brazil sells soybeans in dollars. They produce soybeans, they get dollars. That's what happens. So the dollars enter the Brazilian banking system. A corporate has made money, has sold soybeans, they get the dollars, and they deposit these dollars at Itaú or any other Brazilian bank. Okay. So guess what? These dollars have entered the Brazilian banking system. What happens now? Well, these dollars must be parked or invested somewhere, right? And so what? What will the Brazilian central bank or a Brazilian bank do? What will they invest these dollars in? Of course, in treasuries, because it's the liquid and safest market in the world. So guess what? The dollars reach Brazil through soybean selling, enter the banking system, and then what will Brazil do? They will buy the very bonds that the US issues.
Exactly.
This is the power of issuing the reserve currency of the world. So not only the US isn't issuing in foreign currency, but it's other foreign countries that are buying US denominated debt. And on top of it, the other limitation, of course, is inflation. That's the limitation, Angelo, because Turkey is also issuing in their domestic currency. But if inflation is running at 40% a year and you continue to pour deficits on your economy, you're overeating an already indebted and already hot economy. If you push that to the extreme, you can generate inflation, too much inflation. And then investors start to worry. The example is the United Kingdom. Do you remember late in 2022? We had Liz Truss in the United Kingdom, and she wanted to come up with an expansionary budget, cutting taxes, but inflation was already at 10%. And so they wanted to do more deficits on an already hot and inflationary economy. And bond market said, sorry, I'm not going to take it. And the bond vigilantes came in, and they steepened the yield curve, and they pushed long-end yields higher until they had to change their mind, basically. Inflation is the limitation, excessive inflation, but not the debt per se. The United States issues the global reserve currency of the world, issues the domestic currency. Debt per se is never going to lead to any problem unless inflation becomes the binding constraint. If inflation is already running at 5 or 6%, and the United States comes with a big fiscal package on top, then you will have some imbalances. But unless you get there, you won't.
Well, I'm glad we're on the same page. Most family offices don't quite get it and kind of disagree with me. But again, I do tend to be a little bit different and contrarian, and I'm going to build upon that. So we all know the story that about every 80 to 100 years, a different country, it's been Spain, it's been the English pound, has been the quote unquote world reserve currency. You could argue, if you look at the Fourth Turning and other amazing books and resources, that we're, since Bretton Woods here in the US right after World War II, maybe our time as the world reserve currency is coming to an end. I think, and I've rattled that cage a little bit, but I go back to the question I asked you that led to your reply, really? So then the question becomes, oil settled in dollars? And that's really what makes the world, quote unquote, go round. Now, I do have to bring up, I can't be all rosy about that. We do have challenges here in the US and arguably with the dollar. The world is changing. We have the BRICS Plus, including Saudi Arabia, and there's a push to have an other currency or a basket of currencies, perhaps backed by commodities, not just a thin air and promise like effectively every currency is. In other words, a long-winded way of going about nothing is going to last forever, but what's on the horizon to replace it or make a dent in it And is that still going to take years or decades?
Well, Angelo, if you look back at the past, like you correctly did, you will see that every time you have had a currency, global reserve currency being replaced, it wasn't a walk in the park. It was always a war or a cataclysm or something of these proportions, okay? And so I would say it's not going to be an orderly process, okay? And one thing I want to dispel is this idea that the US is going to sit and watch their country get, the world get de-dollarized like a beautiful fairy tale, and they're going to be fine with it, okay?
They will
So
do anything, and I've said this before, and people think it's a little over the top. The US government will do anything, including
absolutely,
militarily, and they have
absolutely.
discreetly sometimes, to protect the dollar being the reserve currency. Let's just be honest about that.
Absolutely. It's an exorbitant privilege to be able to issue debt denominated in a currency that not only domestically works, but also that your foreign investors will be looking to buy. I mean, that's an exorbitant privilege to have built a euro-dollar system based on dollar debt, which is not only in demand in the US, but also by foreign investors. So the US is not going to stand by and watch this system getting unwound, okay? And it cannot be orderly as well. So let me tell you why. Let's assume that in 5 years, Angelo, we have BRICS Plus. They have grown their share of world trade, their share of GDP. Anything is going smooth for them. And they really decide to go for it. So we have a BRICS central bank that is issuing a new currency that has a solid basket of commodities that are produced mostly by BRICS Plus underlying this currency. Okay? Let's now say that they make a big push to dethrone the dollar. So what will mechanically happen? Let's think about it. You'll have India, Brazil, South Africa, Saudi Arabia. All these countries, all of them, they have dollar debt. Quite a lot of it. We're talking about trillions of dollar debt. Okay. The moment that they decide to get away from the dollar system, it means that they will be selling their commodities, their goods, their services in
100%.
another currency. Okay, let's call it the BRICS currency, whatever it is, and let's assume they can convince Europe, Japan, the UK to trade in BRICS currency, not in dollars anymore. I'm making a lot of assumptions, but let's assume they can. Okay, I have a question. What happens to the trillions of dollar debt once you cannot get your hands anymore on dollar income? Because I'm sorry, you're not selling your soybeans in dollars anymore. You're selling your soybeans in whatever other currency. But you still, remember, you still have dollar debt to service. So how are you going to service this dollar debt? Well, you need to, in some way, deleverage your balance sheet and make sure you can compress these trillions and trillions of dollars and sell them from your balance sheet and pay them down, okay? So you still need dollars. Funnily enough, to pay back your dollar liabilities, you need what? You need dollars, clearly. So the system is built in such an intricate way that to get away from dollar debt, you first need to get your hands on as many dollars as possible and deleverage and decompress this multi-trillion euro dollar system that we have created. It's not a walk in the park. The second alternative could be, let's just default. Let's default on trillions of dollars of debt. So these countries won't be interested in paying it back, nothing. What does it say about your credit reliability, your credit worthiness to the world, Angelo, when you decide to default on trillions of dollars of debt? Who's going to trust to make any business with you?
Exactly.
Is Europe going to trust you? Is the UK going to trust you? No, they're not. So it can happen, and I think it will ultimately, as you said, every 100 years roughly on average, we have a new reserve currency in the world. Maybe it's going to take another 20 or 30 years. Maybe it's going to take only 10. I don't know. But one thing I want to make clear to investors is it's not a walk in the park. It's a fairy tale to think that this de-dollarization can be orderly, because the system we have built doesn't allow it to be orderly, and also politically speaking, it's a big thing for the US to be dethroned as the global reserve currency of the world. They will oppose this as much as they can, and even militarily if necessary.
And then you look at some other issues, and again, I could go on and on about problems we have here in North America and the US, and it's a long list. But I could also state We're still the United States of America. We still have contract law, a population that is aging, but not as badly as China and other countries. And depending on how immigration, which could be a sensitive topic, we could maybe save that one a bit for a different time. We're still an innovation hub, maybe a little bit weaker compared to the rest of the world 10 or 20 years ago, but by far, well, you could argue that. Maybe I went a little too far with the by far, but by far, in my opinion, the innovation hub, the finance hub, and kind of a big exporter, which a lot of people don't know, but I believe you wrote about, of commodities.
Yes.
And again, how much oil do we have under our ground that admittedly a lot of people won't allow us to go and get? But if we really had to as a country for national security and other purposes, we could. In other words, I think, and I'm repeating what I said 10 minutes ago, the death or the spiral down of the US may be just a little bit at the moment overblown.
Yes, I agree. And also, it's important really to stress this. The US is a net exporter of liquefied natural gas. The US is a net exporter of crude oil. And the US is not even exploiting at max their commodity capacity. I mean, the US is a net exporter of commodities. That's important. The US has stronger demographics than any other developed market country, almost out there. Stronger demographics than Europe, than the UK, than Japan. The US has rule of law. I would always ask people, like, do you feel comfortable with investing your money in Chinese bonds? And they will be like, yeah, I don't know. You know what happens if they put up capital controls? Yes, what happens? You can't get your money back in time on however you want. Would you feel comfortable putting 100% of your cash into Brazilian bonds? Oh, well, but what if Bolsonaro or Lula pull up something stupid? Well, again, it's institutional credibility. It's the rule of law. It's no capital controls, deep capital markets, military, democracy, innovation, demographics. Guys, the US might not be the best place on earth, might lack on certain aspects, and it surely does, but it is the cleanest dirty sheet out there. And it's unfortunately, I always ask people, what is the alternative? And the alternative generally, as you have seen in the past, used to be another country, another empire. And now the answer needs to be much more creative, like a block of countries. None of them have any proper rule of law, any proper democratic setup. And then they need to be cohesed together to create a new currency backed by commodities. Can it happen? Yes. Is the probability reasonably high? I wouldn't say so. And I think this gets blown way out of proportion by people, while they should be focusing on other risks that are actually more relevant to their portfolios within a reasonable time frame of 5 to 10 years.
Indeed. And you mentioned rule of law, and I talk about that as well. That hints back to what I also said one or two times already. I admit, if you have a weak military, your rule of law likely means nothing. So again, it's backed by the strength. Military absolutely plays into it. Listen to some of my geopolitical interviews with generals. At my events, I've interviewed people like General Wesley Clark and many others. This is just a reality of how the world works. I don't care how it sounds to many of you. It is just flat out a reality. Changing subjects a little bit, but staying somewhat, because this is kind of a macro discussion. You also have written about things like expectations for real GDP growth, what is really a true core inflation, and what is going to happen, do you think, in 2024 with the Fed cutting rates or staying stable or, God forbid, raising rates? We're almost at the stage, Alfonso, where we have about half an hour left. I got a million things to cover. Maybe we'll begin to keep this a little rapid fire.
Sure, let's do that. So I think the Federal Reserve is politically motivated to cut before the election cycle gets into the heated part of the discussion. So I would say they really, really, really want to start cutting in June so that they can do June, September, maybe November or December, let's say 3 cuts minimum this year. And they want to be able to start as soon as possible, so to be then not, pointed at as political. They want to start as early as possible. growth data doesn't really agree with them, Angelo, though, because the private sector in the US is creating over 200,000 jobs a month on average. 200,000 jobs is quite something. Net immigration has ballooned in the United States last year. A lot of people are coming. The labor force is expanding. It looks great from a growth perspective at this point. And when you cut rates, when growth looks good, I think bond markets can start getting a little bit shaky at the long end. And I think gold has also started to smell that the Federal Reserve is about to make some sort of a policy mistake here.
Yes, and that is keeping it going. So in macro, and I believe you also wrote about this as well, money is made from successfully deviating from a consensus. Therefore, where is the consensus currently wrong?
I would say that at this point where the consensus is wrong the most is assuming that all central banks around the world are able to keep up with the Federal Reserve, Angela. I think that's wrong. The market is expecting UK, Australia, New Zealand, Europe, all these countries, they have vulnerabilities inside them, okay? The private sector is highly leveraged. They have other sort of fragilities, okay? Yet, the market is treating them as if they're able to compete with the hawkishness of the Federal Reserve, as if they're able to handle higher for longer equally well as the US. I think that's really, really wrong. It's probably the place where the consensus can be the most wrong.
What is your definition of being contrarian? Is it basically thinking for yourself?
The first thing for being contrarian is knowing what consensus is saying. This seems very, very trivial, but you should be able to always measure consensus. So where is consensus? So in my investment framework, in my macro hedge fund, I have quantitative tools to track what is the consensus view at every point in time. Know your enemy, because we don't invest in a silo. We invest against consensus, Angela. So first of all, you should know what consensus is, right? Once you map it out, being contrarian is very glamorous. People always want to be contrarian. You know, it makes for nice clicks and nice interviews and nice attention. I think there's a time to be contrarian and a time to ride the trend. So one of the most important skills of a macro investor is to be able to be flexible and do both. But importantly, measure quantitatively things. Macro is so big. You need to cover all countries in the world, all asset classes in the world. If you're not able to clear out the signal from the noise and to measure what consensus is saying, you're really starting from a disadvantage.
What core metrics do you look at to make an investment? Let me give you a little bit of context.
Sure.
There's so much information out there. We get stuck in information overload. It's an unrelated subject, but it's been proven scientifically that the more inputs a VC investor has on an entrepreneur, actually past a certain point, the worse their decision making becomes.
Yeah.
There's a guest that I have on frequently. He's among my most popular guests, kind of a macro thinker. His name is Adam Robinson. And he really talks about, for the majority of people, you should probably focus on 2 or 3 core metrics to at least do your initial to mid-level overview into the tactic and thematic approach that you're going to take. And then from there, you may dig a little deeper. Do you believe that there comes a point when there's too much information coming at you? And what do you look at as your top 1, 2, or 3?
I strongly believe that's the case. If you're a global macro manager like me, then it's even more true because, as I said, you're supposed to look at economics data and asset classes from all over the world. That's way too much information. So how I solve the problem is I have quantitative tools where all this information is actually thrown into, analyzed, and then outputs, synthesized, important outputs are spit out every day. Okay, that's the way I try to clear the signal from the noise. If I were an investor, I would be looking at really 2 things when I make an investment, like my 2 core metrics I would be looking at. The first is old as, I would say, water, and it's valuations. I mean, there is a guy smarter than me that says price is what you pay, but value is what you actually get back, depending on the valuation that you have actually locked in when buying an asset, okay? And while valuations cannot be an explainer of returns for the next year or the next 2 years, Angelo, namely expensive things can get more expensive in the short run, valuations have a good explanatory power when it comes to 5 to 10 years ahead, which is the time horizon that most wealthy family offices should be looking at, I believe, okay? Rather than chasing performance over the next 12 to 18 months, you should focus on the medium term. And valuations are a very, very important determinant of forward returns in 5 to 10 years. And the second thing, again, is ask yourself, how crowded is a certain thesis? Because at the end, we're talking about prices and asset prices. And to push higher the price of an asset, you need a new marginal buyer willing to pay a higher price. Well, guess what? If everybody and their mother and their taxi drivers and their dogs have bought the same asset, namely, if the asset is extremely crowded, your possibility of finding a new marginal buyer is lower and lower and lower. So being a bit contrarian in nature, trying to understand where consensus is, and looking at valuations, I think those are two very solid recipes for having positive, meaningfully positive returns on a 5 to 10 years time horizon.
I mean, I hinted at it with slight tongue in cheek a couple of minutes ago, but looking at a commodity and looking at the amazing exponential return in cocoa, I mean, who would have thought that? What kind of metrics would you potentially look at? And if that made up a percentage, however volatile it may be, of a macro portfolio or any investment portfolio, it basically would have driven a massive amount of your returns, probably more so than Nvidia could have a year ago. Yeah. It's crazy.
Yeah, and that's why diversification is something I hinted at before. So a macro manager, generally speaking, is not very interested in cocoa, although he should from a certain perspective. And let me explain why. As a macro investor, you're looking for macro volatility in the world, okay? You're looking at different cycles. You're looking at idiosyncrasies. You're looking at opportunities across economies, okay? Now, what if, Angelo, there is no macro volatility? So you're a macro investor, but the world is pretty boring, okay? You need orthogonal strategies. You need other strategies in your portfolio that can make money also when macro volatility is very low. So what are these strategies? Where they're expressions of risk premium. For example, carry is a risk premium, or trend is a risk premium. And commodities are very, very trending assets. They have these as one of their main features. Okay, so as a global macro investor in my fund, for example, I also deploy orthogonal strategies that involve carry and trend to try and capture this risk premium in market. So even if I don't have a macro thesis on cocoa, it might happen that I am in the trade because the trend model is saying to be in the trade. Basically, one of the important features of a macro investor is to be flexible and is to be diversified in his strategies, trying to capture risk premia wherever they're available. Of course, your focus should be macro and macro volatility, but you should be nimble to try and harvest other risk premia that are always available in the market, including trend, and commodities are clearly a very trending asset.
Do you have any opinion on Bitcoin, especially now that we have spot ETFs by massive major companies here in the US?
Yes. Bitcoin is a macro asset that serves a pretty clear purpose, I believe. Studying a bit the price action of Bitcoin, although it's a relatively young asset, so you should always take this with a pinch of salt, and it's evolving as well as price action and its role in a macro portfolio. Bitcoin is basically a high beta aggressive version of gold. And what do I mean with that? What do I mean with that is the following. It has two properties. The first one is it's a convex disruptive hedge for your portfolio. So namely, if we are about to change our monetary system, if fiat currencies are getting dethroned by another system, and we just discussed about the BRICS currency, but that's another form of a fiat currency backed by commodities. What if instead we are walking back to a probability where gold has to serve a strong role as a hard asset to pin the monetary system, okay? Will today something like this work? Well, not really. We're a highly digitalized economy. I mean, having a hard asset like gold, which is not easy to transfer, can be a bit complicated in today's economy. So what if we're trying to walk back to a system like that, but instead of gold, we want to also use a basket of scarce digital assets, for example, Bitcoin? Now, what is the probability that something like that will happen? Pretty low. Okay, let's say 5%. Cool. What is the probability that Bitcoin covers a role in that transition? Pretty high, I would say, in a digitalized economy. Great. What is Bitcoin's market cap as a percentage of gold? Well, it's about 10 times as small. So gold is 10x bigger as a market cap than Bitcoin is, or even more. Okay, clear. Are there therefore a probability weighted chance that Bitcoin could go up in price as an hedge if we work towards that transition to a new monetary model? Yes, definitely there is. So it covers a role as a monetary hedge, basically, in a digital world. What is the allocation that is a relevant one to make that something that makes sense in your portfolio? A few percentage points. 1 to 2% is generally enough to obtain the properties without having to sacrifice too much notional being invested in Bitcoin that could be invested in other asset classes, more traditional asset classes. So one needs to be, I think, very based when considering Bitcoin, because it's easy to get dragged into manias and YOLO. And, when it's going up 100% in a year, everybody wants to jump on the boat and become a maximalist, Angelo. But I think Bitcoin should be treated exactly like a high beta monetary hedge, like gold used to be and still is today, still has that property today, Angelo. Then Bitcoin should be treated in a similar camp with similar properties, but a more high beta version of that.
Why haven't gold miner stocks exploded the way that gold has?
Because what we're witnessing here, I think, is not a retail-driven purchase of gold. If you look at the trend in the volume of gold ETFs, which are the typical expression of the retail buying gold, right? They would buy gold through gold ETFs. If you look at the gold price action and and the interest in gold ETFs, you would find a very tight correlation until 6 months ago. It broke. So what it's telling you is that retail is not driving this gold price action. They are not buying a lot of shares of gold ETFs, okay? Who's buying? Probably central banks. Most likely, central banks are slowly but surely diversifying away their portfolio. As we said before, they own a lot of treasuries. Sure, they do. But maybe they're thinking, well, let's diversify a bit our asset ownership, right? The Bank of China is famously buying a lot more gold than they're buying treasuries lately. And so this is why gold miners are not joining yet, right? Because this is not a retail-based performance that we're seeing in gold. This is actually a much more institutional, central bank-driven performance in gold. And central banks are interested in buying gold miners. They're interested in buying gold. I think that's why we see the divergence. I'm not sure for how long this can last, because gold miners are now ridiculously cheap. Looking at the cost, let's say the break-even cost of production of gold, and looking at the price that they can sell the gold today, there's a lot of free cash flows in there, which hasn't yet been priced into stock prices.
Given, shockingly, Alfonso, that some colleges actually play some of my interviews in their finance class, or sometimes they're even an assignment. I'm very proud. I don't know why they would pick me. I think I am going to throw in a little bit of a surprise question. What advice would you have to a college student or graduate that is interested in the world of finance, but knowing that we're in an intriguing world right now? AI is going to make an impact. Bitcoin, we would have never spoken about even 10 years ago. Do you have any advice for a young one that is up and coming, maybe even in high school, that wants to be involved in the world of finance?
Two things then, I would say. The first one is work on your communication skills. This seems to be completely unrelated to finance, but it's not. Because in an ever-changing world and so complex, being able to deliver your thinking in clear words and with the high level of communication skills will turbocharge your career. And this is not only for young people. I think this is for everyone. Being able to present concepts in a clear and concise way, it's a superpower nowadays. And the second thing, to a younger audience, I would say, is learn the power of coding. In general, coding doesn't have to mean that you need to become a software engineer, but being able to understand the mechanism and the algorithm behind coding can also help you become way smarter when it comes to these technological developments that we're facing and we will be facing over the next 10 years. Coding, communication. Those are the two things that I would really, really try to focus on today.
Excellent. Going back a little bit to the issue of GDP, Raoul Paul has noted I mostly agree with him on this, but it gets complicated. We're no longer constrained by resources, unlimited power through nuclear, but try getting that through politically. It's been a little challenging.
Yeah.
Unlimited intelligence through AI, but we're a little early. Unlimited productivity through robots, but we're maybe a lot early. But I think the big picture is the formula for GDP is going to be rewritten. Broadly, that I agree with. Given our limited time constraint, we could build a whole podcast around that. Either one, broadly a comment, or two, especially the impact of AI and the impact of workers in GDP.
I would say that it's clear that there are some potentially disruptive and positively disrupting productivity trends here. So we could be talking about AI, we could be talking about robotics, but there is one small caveat that I need to be able to put out there is most of the productivity growth of internet or the advent of technology, okay, when it comes to digitalizing our economies, was achieved and almost completely exhausted in the first 10 years. So between the 90s and the early 2000s, basically. And why is that, Angelo? Because productivity measures basically goes up very fast when the marginal impact of a new technology comes in. So basically, when we discover something new and that something new permeates different sectors of the economy, the productivity impact, the marginal productivity impact will be very, very large in the first innings, okay? And then it will be slowly declining over time as the economy matures around that new technology. So it's a bit naive to extrapolate that productivity trends will double and remain at double the level for the next 10 to 20 years because of AI. Although it's true that AI is something new that we are working on and discovering and developing as we speak. So over the next 5 to 7 to 10 years, it might be we reap the most benefits out of it. I still want to put up the caveat by with the marginal returns, let's say, of this increased productivity tend to decline over time. This is true with every technological development in history in humanity.
Another subject we could cover for 1 hour, but we'll give it maybe 30 seconds. Relative to that, AI, future GDP, the world is changing. Is it inevitable that we are going to need to have universal base income?
Ooh, what a question. I think a couple of countries have played with that. Finland, famously in Europe. So far, all the experiments haven't been particularly successful. Obviously, if robotics and AI really deliver this productivity growth that we expect, then it is definitely a subject we need to entertain more closely. But honestly, it also comes with a lot of societal impact that we need to consider here. So again, this will be a topic for an hour podcast, Angelo. I'm sorry if I can't add a lot of value in a small limited amount of time. Super interesting question. Not particularly applicable in the next few years, I think, but maybe in 5 to 10, yes.
And comment that will lead into a question that gets into perhaps a sensitive geopolitical area. But again, we want to put all these, as much as the 1 or 2 minutes we could give it, chips on the table. But that the country Hegemony would face head to head with the UK and the US. Who would have thought that even a year ago? That Russia would confront NATO directly relative about Ukraine. And related to that, that Russia would have effectively, and I think Jim Rickards said this, demilitarized, at least via ammunition, all NATO countries. Russia having a more important military industrial base and capacity ex the US than all NATO countries combined?
I mean, the geopolitical situation here is definitely evolving. You're seeing as well China becoming more serious about Taiwan. You're seeing a lot of these geopolitical forces that are underlying and they are shifting. I think this is relevant when it comes to portfolios. This is relevant when it comes to how people invest. Geopolitics really wasn't a thing for the last 7 to 8 years. And it's an additional layer of volatility people really, really need to consider when it comes to their investment allocation.
Absolutely. The research that was done late in 2023, not just mine, but UBS, Goldman, the number one concern of family offices in 2024 was geopolitical, followed by inflation, followed by recessions. Broadly, things that we're kind of course, talking about today. We have
Yeah.
about 7 or 8 minutes left, so we're going to pick up the pace and probably do 2 or so more questions, then effectively, I guess you could say, go to a bit of a close. Do you think oil in the US by the end of this year will reach $100 a barrel?
No, I don't think it will. I think what's going to happen is that we will get close to it. And how is by the Federal Reserve signaling cuts are coming despite economic activity remains robust. Commodities are a clear winner, a bit like in the second half of 2007, if you remember, Angelo. Pretty similar situation. The Federal Reserve came in and cut interest rate. They were scared about the housing. Actually, they were right with hindsight, but the market wasn't really that scared yet about the housing cycle. Yet, the Federal Reserve was cutting rates and commodities went through the roof. Now, I think oil has already done a lot. Gold has already done a lot. They can go a bit higher. $100, I don't know. We could get close. Now, at that point, what happens is that you are squeezing the private sector. You're really squeezing it. Interest rates have been higher for, at that point, 12, 18 months. Oil, a higher oil price means that household consumption needs to move lower because a higher proportion of your salary needs to be allocated to gasoline and to other oil-related products, right, and expenses. And so at that point, you get closer and closer to recessionary conditions. Higher commodity prices, especially for countries that are net importers of commodities, like Europe, like the UK, like Japan, for example, can actually be a harbinger of a recession. So I think this is the path, right? The Federal Reserve cuts too early. Nominal growth seems strong, commodities go up, interest rates have been high for a long period of time, and finally all these pressures converge together on the households, and they finally crack the labor market.
Will the winners in the second half of 2024, and this will sound boring, could they be treasuries, gold, oil, although you may disagree, and broadly king dollar, which isn't necessarily treasuries? I could argue the metric for that may be the Dixie.
So I would say for the second half of the year, an asset that I like is to buy 2 to 5 year bonds in the US, and you can have some well thought of leverage there if you want to try and make some more relevant returns for your portfolio coming from that part of the investment world. I think when you're so late in the cycle, when you have the Federal Reserve stubbornly deciding they want to cut interest rates, this will probably send the long end of the yield curve to steepen pretty aggressively. It will send commodities to go higher. This should happen in the next 3 to 4 months, and it's already happening as we speak, Angelo. And as I said, ultimately, this will put more pressure on the household sector, on companies, on the private sector. And at some point, the tightness we have accumulated over the last 12 to 18 months will ultimately bring down the labor market. And as it brings down the labor market, those 5-year treasuries locked in at about 4.5% as we speak today will prove to be a pretty safe and liquid investment that importantly provide family offices and investors with optionality. That means when you get the drawdown, you actually have a liquid asset that is appreciating, that you can liquidate and you can reallocate into other asset classes that are trading at a much better valuations and at a discount.
You could pass on it, Alfonso, but I'll ask you, do you have an opinion and potentially impact on the markets of the US presidential election heading into November of this year?
Well, I think that it's funny to see that Biden's approval ratings are not going up despite the fact that the economy is actually doing well, because normally there is a very close correlation. So that doesn't really bode well, I think, for Biden. I'm not breaking any new grounds because at the moment, odds are for Trump to be the favorite. To be frank, it will be probably a very tight call up to swing states. And I don't think the market will be focusing on it until we get to summer. The moment we get to summer, it's going to be probably the only topic in town.
I agree.
And clearly, the thing that makes a difference above all is Trump behavior when it comes to foreign policy. So when we go again with tariffs, when we go again along these lines of potential inflationary politics, then it can become really volatile again for markets.
Because I want to give 2 or 3 minutes for you to talk about what you're doing A final question, you can be super quick. It relates to my young ones, college kids questions earlier. What's the one thing you wish you known when you started that you now know?
The world doesn't end tomorrow. Whatever you hear, whatever crisis you're facing, whatever headlines are popping on your Bloomberg or on your screens, fear is a very, very heavy emotion in markets, okay? So I would like to have printed something on my computer that says, most likely the world doesn't end tomorrow. And looking at that reminds you that when there is blood in the streets and panic, that's not the moment to panic, but it's the moment to look for opportunities to buy.
Very well said. I'm going to give the floor in about 30 more seconds to Alfonso, but a little bit of a heads up, then I will wrap things up. Alfonso is going to have to run, so he'll miss my close. I do recommend you stay. I'm going to have several announcements to make that could be important. So stay tuned. And right before I kick it over to Alfonso, and I'm sure he'll agree with me, this is for entertainment and engaging educational purposes. As we get new inputs in, our opinions change. The world is changing. So you're listening to this in early mid-April of 2024. You may watch this a day from now, a month from now, 2 years from now, and our opinions, which is what this is, could be totally different, kind of like playing poker based on new input that is coming into us very quickly. At the end of the day, make your own decisions, think for yourself. And when you invest, you need to consider liquidity, time horizon, and the fact you could lose your money. So again, do your own diligence and make your own decisions. Alfonso, first of all, I'll note to the audience, they have to follow you on, used to be called Twitter, now it's X. Yeah. So why don't you start with what is your handle on that so they can look you up and follow you?
Yeah, the handle is at macroalf, ALF, first three letters of my name, macroalf.
Yes, it's very simple, known as Alf, easy to find on X and a must follow. And by the way, Alfonso's last name, I'll spell it, P as in Peter, E, C as in Charles, C as in Charles, A, T as in Tom, Iello. Alfonso, when I was introducing you, I noted after your amazing experiences, you'll be launching your own macro fund. If you could share with our audience in your final minute or 2 minutes or so, a little bit of some of the context behind that and maybe how people could reach out to you.
Sure, Angelo. So I used to run $20 billion at ING, and then I went into an advisory business that I still run today with hedge funds, family offices, etc. But now there are plenty. The set of opportunities out there over the next 5 to 10 years for a macro investor will be very, very large. So I think the time is ripe to go back and open a macro fund to try and exploit these opportunities. So the macro fund that will be running launches in Q4. Now I'm in the early investor phase where I'm offering investors preferential terms to come in as an early investor into the macro fund. Then, the fundraising is going pretty well as we speak. So the window will be open for a few more weeks. And the aim of the fund is to try and generate uncorrelated double-digit returns. That's the target of the fund. Uncorrelated is the key word here. I'll be trying to add diversification with strategies that benefit from macro volatility. I won't be buying stocks. I won't be giving you beta that you can get way cheaper elsewhere. This is global, macro, uncorrelated, absolute returns. That's the strategy. Now, if people are interested because they understand geopolitical risks, an ever-changing world, fiscal deficits, and everything we talked about in this interview, they can just reach out at the following email: fund@themacrocompass.com. The Macro Compass is what you see there on the background. It's the name of the company. Fund@themacrocompass.com. Just drop a line. I'll be sharing with you all the material, all the information, always open for a conversation, especially with family offices and other type of investors.
Thank you, Alfonso. And I highly recommend having a chance to reach out. He's obviously a brilliant thinker. Follow him on X. Rewatch this video. There's lots of nuggets here you're effectively getting for free. But having a true professional focused on uncorrelated returns and being a resource to you in many different ways, I think could be very valuable. As he noted, this will be a new launch, And I think there is some special opportunities, including if you just reach out to him or an introduction from me, if you desire, and mention my name and have an opportunity to maybe get a little bit special access, a little bit more insight, a little bit of a special 30-minute consultative conversation, or a variety of ways that it could go. So hopefully among the value that I bring is interviewing amazing people and giving you, to some degree, a level of favorable access or connectivity with them that hopefully provides value. You might as well use it. Alfonso, I know that you do have to run. I probably left about 30 questions on the cutting room floor for the next time. I am going to give some updates and a pretty detailed close from my perspective. You have to run. I totally understand. And I look forward to our connection shortly. And for the audience, I'll give about a 3 to 4 minute wrap up, including some announcements that you may want to hear. But I appreciate your time, Alfonso. Thank you so much.
Angelo, it's been a pleasure, and thanks everybody for listening.
Thank you. And everyone, wow, that was really great. Alfonso, someone who I've followed for a long time. It was great to reach out to him. Little did I know that he's watched some of my interviews before and made me feel good. He's like the one subscriber that I do have. And again, I have a lot of questions, but not everyone has the 2.5 hours that Adam Robinson and some others at least have given me in the past. Who knows about moving forward? So one, I recommend my more classic channel on YouTube is at Family Office. It has a pretty good number by my standards of subscribers, and a lot of my classic interviews with Tony Robbins, with Michael Saylor, with Mark Faber, and so many others is up on there. My newer platform with a little different twist is Family Office TV, also on YouTube. So they're free. Go and subscribe to both. I am doing a fair amount live at the moment on LinkedIn. LinkedIn, I have my most significant following, so you could find me. I'm simply Angelo Robles. Look me up and follow me on LinkedIn. I highly recommend it. And really, a lot of my stuff is very simply on my URL, my website, which is my name, angelorobles.com. So in terms of some updates and comments, I think Alf today was amazing. I've been a little more quiet the last couple of weeks because I've been traveling more than I have in probably 2 years, besides months ago, my great trip to Europe, which I enjoyed talking about. I've had a chance to do much around the country, including in Miami and Palm Beach, where I'm very active, back also into New York City from Connecticut and Jackson Hole, Wyoming. So that's been a lot of fun, especially as the weather's getting just a little bit better now. And this Friday, it's not going to be live, meaning Friday, April 12th, but it will be recorded and distributed the following week, the week of the 15th. I have a chance to interview. I've interviewed him in person before, but this time digitally, the one, the only hedge fund icon, multi-billionaire, incredible investor and philanthropist, Leon Cooperman. So I'm really, really excited about that. Again, I'll be doing that this Friday, and I'll distribute it on my platforms probably Monday or Tuesday, meaning the 15th or the 16th. I have other amazing people lined up as well. I don't need to do as many of them as I've done in the past. I think it's quality over quantity. So some of you are still asking, and my website has gotten better at clarifying what this is. My Family Office TV, I love to do a little bit of a branding exercise, my media arm, and sharing my unique perspectives, maybe a little raw around the edges with my questions and my interview style. But I don't want to be boring. I don't want to be vanilla. I want to shake things up, and I could be a little different and contrarian. So I hope you're enjoying some of my interviews. Go on my platforms, especially in the live tab, because I haven't transitioned a lot of them to the main page. So a lot of my more recent interviews going back really 6-7 months, if you click the live tab in YouTube, it'll take you sequentially to the 30 or 40 that I probably have done on a lot of different subjects in the last couple of months. So back a little bit to 2 things I wanted to note before I exit. I've been incredibly busy. It's been great. Again, I sold Family Office Association, my love of near what felt like 20 years just last year. So it's been over a year now. Took a little time off, traveled, set up my family office and structures out of Jackson Hole, Wyoming, and have become a moderately active investor, including in privates myself, which on the website, you'll notice some things relative to my private club, which is my next comment, SFO continuity. That is really focused on preferably single family offices and ultra high net worth investors, including family members and or the executive, especially if they're active on the investing side. 30 founding members still building towards that, then a pause, then perhaps a year or two down the road, selectively new members, but no more founding. That's it. Now is the time, and this is discussed on angelorobles.com, to become a founding member. Be a part of my intellect and research that I share with myself and my community to you only as a member, special access on Zooms and digital, and the fact that I've been pretty darn active from Vienna to London to Palm Beach, Miami, LA, New York, Greenwich in just the last couple of months in person. I have no interest in doing larger scale events and having a truckload of sponsors and vendors. It's kind of the last thing I think that I want to do. It's intimate dinners, me and 2 people, me and 4 people. Maybe a large one to me at this stage is probably me and 7 to 10 more investing centric family offices talking about building an empire, creating holding companies, buying companies that are cash flow producing, but also about public markets. So it's not just private, and really deep intellectual conversations where I'm learning so much. And I would like for many of you to be a part of it. So simply go to angelorobles.com, go to my membership tab, and you'll have an opportunity to learn so much more. I love to teach. I've built family offices around the world, and the educational aspect about what makes a family office great, I now have a new platform under Masterclass at angelorobles.com, where it doesn't need to be live in person, which is very expensive, I'll be honest, but I still love to do them, or where I teach it live on Zoom. But I had a chance to professionally record a series of videos that's available at an incredible price that is simply 24/7 accessible right now. And the one that's up there is really my anchor, how to create or reimagine into a top 1% family office. I give you my all, as much as I could, within 4 to 5 hours of content that is broken down, including some PDFs and other downloadable content. I've been around the world. I've participated and paid for other platforms and programs, and I've gotten some value out of it, but there's very little on creating a family office, practice management, how to make them better. I still go with the fact that most family offices are at best mediocre, maybe 15% are good, and probably only 3%. But 1% sounds better, doesn't it? But only 3% are truly great. And then how could I crystallize what makes them that if a lot of it is qualitative, as long as quantitative? It's hard. But understanding that people are the most important resource, doing the structure right, understanding technology and systems, and understanding that, again, by far it's people, getting the best out of them, KPIs, which are key performance indicators, objectives and key results, leadership tactics, the impact of technology and AI, and how to amplify, and so many different insights from real family offices that I've interviewed, that I've known, that I've worked with, that I share. So the opportunity to go at angelorobles.com, if you're not quite qualified or ready for membership for relatively a pretty nominal price, to have 24/7 access in the Masterclass tab to what I'm doing there, and then reaching out to me and scheduling 30, 60 minutes, like, I'm good. This is what I love. This is what I do. And I would love for you all to be a part of it. Simply, you can learn about all of this. I have a pretty simple website. It's angelorobles.com. Reach out to me on social, follow me. That's all free. I love to give back. I appreciate all of you. I got a very active schedule this spring into summer. No pedal off the metal this summer, maybe a little downtime to relax, but I'm here to work. I'm here to meet with incredible families and family offices. I have a lot of programming I'll be doing in the Hamptons, New York, even Florida. I know that's rare in the summer, but you got to do a little bit of it. And of course, California, then maybe another trip back to Europe. So lots going on. Have a chance to join me. I appreciate you and thank you all for your time today.